Division 293 tax, or more commonly referred to as Div 293 tax, is a tax that reduces the tax concessions on super contributions. It only impacts you if you're over the Div 293 income threshold. Today I'm going to go through what that threshold is, how the tax works, and what options you have. You will only pay Div 293 tax if you're over the threshold. Now the threshold is currently set at $250,000. Now income is calculated in the same way that we calculate income for Medicare levy surcharge, but we're excluding any reportable super contributions. So we're pretty much going to be looking at a taxable income, and then we're going to add in back things such as total reportable fringe benefits amounts, net financial investment losses, rental property losses, and there's a few other things there. So just remember that your taxable income isn't equal to your Division 293 income. Now just remember that if you're under 250,000, say 240, you also need to be adding on your super contribution, so this could push you over the $250,000. Now your income does also include things such as once-off capital gains events, so that is something to consider. So what is the Div 293 tax? Well, if you're over that threshold, you will pay a tax. Now the tax is at a tax rate of 15%. But it is either paid on your taxable super contributions or your income over the threshold. So for instance, if we earn $260,000 of income and we have $25,000 of super contributions, our tax is going to be calculated on the lesser of $25,000 or our income over the threshold. So we have $285,000 less the $250,000, which is $35,000. So we're going to calculate our tax on the $25,000 because that is the lower amount. Now the tax on that is going to be $25,000 by the tax rate, which is the 15%, which is going to give us a tax of $3,750. Now before I get into the options you have and whether you can actually avoid Div 293 tax, one of the options you do have is to subscribe to my email newsletter. So the link is in the description to this video, and on that newsletter I'm dropping weekly tax tips delivered to you free. I'd love for you to go and sign up. Now let's talk about what happens if you get a letter that says you owe Div 293 tax. What are your actual options? Can you avoid it? Well, you can't avoid it if your income's over this. So the only way to avoid it is to earn less money or not make any super contributions, which obviously isn't always practical and might not be the best advice for you. But what you need to do is go, what are my options if I now owe this tax? So luckily the ATO do send out quite a detailed letter which goes through how they calculate it and what your options are. So you can either pay this tax out of your own money, so you just pay it like any other bill, or you can elect to have funds released from your super fund to pay the tax on your behalf. So you need to consider what option is right for you. Obviously paying it, there's not really much to consider, you're just going to be paying it. If you're going to elect to release funds from your super, you need to determine, is that actually the best option for you? Especially if you've gone and voluntarily put those funds into super, you're now drawing funds back out. So definitely do your research, speak to your financial advisor about whether that option is actually best for you. If you're considering putting extra money into super, one of the considerations you must make are what are the tax impacts. In this upcoming video, I go through the tax impacts of making extra super contributions. I hope you've enjoyed this video and I hope to see you over there.